Oh dear, 4.3 trillion in the last 7 days. 7 straight days. The stocks fall for the most since 2008. Oh no, the market's crashing. Guys, we need to do something now. Hey guys, Drew Rice here, and all jokes aside, I hope that everybody watching this is safe and healthy right now, because that's what's most important. But regardless, there are a few things that you need to do right now, and those are wash your hands, make sure you're getting plenty of vitamin C, sleep, and nutrients, and buy stocks. In today's video, I'm going to be telling you about why it's time to invest, why fear is good, and how you can get started today. So make sure to stick around to the end of the video and let's start learning. So if there's only one thing that you get out of this video, I want it to be that you do not wait to invest. Get started. Nothing is more powerful than time in the market, and waiting is costing you money. Another thing to remember is that you want to invest in fear. One of my favorite quotes on this is from the great investor Warren Buffett, who says, "Be fearful when others are greedy, and be greedy when others are fearful." Basically, what this means is that when everyone in the stock market or in Bitcoin is buying and making the price shoot up towards the moon, if the fundamentals don't line up and that price is going up too fast, then most likely the people investing in it are being greedy. So you generally want to stay away from things like this because it will probably end up costing you money when it drops down. Meanwhile, when you have a situation like right now where things are dropping in value, people are running away from the market and running away from investments as fast as they can to try and not lose money, and these people are being so fearful, you need to be looking at that as an opportunity of getting in now because you're getting everything on sale. Don't be fearful. Be greedy. This past week, the market dropped more than it has in any single week since the 2008 financial crisis. Additionally, the Dow dropped the most that it's ever dropped in history on Thursday. This is definitely a time to be cautious, but it's also a time that illustrates the value of opportunities like this. When wondering whether to invest or where to invest in a time like right now, I think you need to ask yourself, does this outbreak pose a fundamental threat to whichever company or industry that you're looking at investing in? And if the answer to that is no, that those companies are still going to fundamentally be the same and be able to earn the same long term, it's a great time to buy them because they're on sale essentially. While they may take a dip in the next couple weeks or months or even the entire year, we don't really know because of the outbreak, because of supply chain issues, because of consumer confidence and what consumer spending habits are going to be. But we know that even if prices go down in the short term, that if it's a good company with solid fundamentals, the prices are going to go up in the long term and it's going to be a good investment. To give you an example of what type of companies are on sale right now, last week, Apple, Amazon, Walmart, Starbucks, and Microsoft all dropped over 10% in a week. That's insane. Getting a deal on one of these companies that is a stalwart of the stock market is huge. It offers a great buying opportunity for people looking to invest. I'm sure some of you watching are thinking, wait, Drew, we don't know if this is the bottom of the market. Just because these stocks dropped over 10% doesn't mean that they're not going to keep dropping and we may lose money if we buy in now. But the thing is, you can't time the market. None of us truly know that there is a market bottom until after that bottom has passed us by. So by having this mentality, you're never going to actually be able to take advantage of the bottom unless it's by sheer luck. That's why it's better to just put money in the market over time consistently using what is called dollar cost averaging. Dollar cost averaging essentially takes out the guesswork of when a stock is at the bottom or when a stock is at the top, and basically has you just betting on the market as a whole or that individual stock, that it is going to continue going up over time, and you're going to buy it sometimes when it's low, sometimes when it's high, but over time it will end up gaining in value, and because of the time in the market and the power of compounding interest, you will have gained a good amount on your investment. This is why another proposition of Warren Buffett is for the average person to just buy into a broad index fund like the S&P 500 and not put all that money in at once, but instead just to consistently put money in and buy it over time. The reason he suggests an index fund is because, one, they're able to spread risk over many different companies. As an example, the S&P 500, instead of all that risk being on one company, it's spread pretty evenly between the top 500 largest companies in the US stock market. This way, it's very unlikely for your investment to be affected negatively by one of those companies having really bad earnings in a specific quarter, or a lawsuit come up, or anything like that. So it essentially just protects you from the risk of one company and spreads that risk across many, which overall will make you have a generally safer investment. The second reason to invest in a broad index fund is because it's been shown historically that the average stock picker or fund manager is not able to beat the return of the S&P index, and that's with them working all the time trying to learn as much as they can and get as good deals as they can, because you just can't beat time in the market. To illustrate the power of time in the market, here's an example of how much you can miss by waiting to time the market instead of just getting in consistently. Historically, the market goes up at about 8% per year. And when you look at a compound interest calculator to see how much you need to save each year, it will blow your mind how easy it is to get to a $1 million investment portfolio. As an example, if you started about 18 or 20 and you invest less than $100 per week, or you just put in your tax refund each year with an average tax refund of about $3,000 per American citizen, you're going to end up with over $1 million just by doing that. And it's just something you have to get started on. And since it's tax time, I think one of the best ways to get started is, like that example, when you get your tax refund, put it in a Roth IRA, put it in the market, buy index funds. And then the second way is, if you aren't already doing this, is make weekly contributions to either an employer 401k, an IRA, or to an individual brokerage account. Make it a set amount each week, whether that's a percentage of your pay, or that is, say, $50 or $100. Put that in the market every single week, regardless of what is happening. And over time, this will help you with dollar cost averaging and set you up to grow your investment. So the action items I want you to do are to start now and to invest often. One great way to do this and to reward this habit is to use brokerages that don't charge commission fees. That way you're not paying more in commissions because you're investing more often. And that's why I really love both Webull and Robinhood. These are both brokerages with very good mobile platforms, meaning that you can trade stocks on your phone. And I think it's a great way, especially for young investors, to get started in investing. In addition to not charging any fees, both of these services give promotions for signing up. As an example, with Webull, when you sign up, you will automatically receive one stock that's valued up to $250 in your account. And then when you deposit any amount into the account, you will get a second stock that is valued up to $1,400. I really like Webull. I think it's a great service because they have a lot of the premium charts that you look for in a more traditional brokerage account that does charge fees. At the same time, it's very easy to use and accessible since it's on a mobile platform. And they also offer IRAs. So if you're looking to set up a Roth IRA, this is a great place to start. And if you're interested, be sure to look in the description box below, because that's where the referral link is, and get yourself 2 free stocks, and let me know in the comments what 2 free stocks you ended up getting. Robinhood is very similar to Webull. I think it's got a little bit more simpler charts for people that are new to investing, which means that it might not be everything that a seasoned investor wants, but for someone just getting started, it might be a little bit easier for them to understand. And it's what I ended up starting on before Webull was around. So also be sure to check that out. When you sign up for an account with Robinhood, you'll also get a stock, I think valued up to $150. That link is also in the description box below. And then the other one that you absolutely should be doing, especially if you have an employer, is automatic 401k or IRA contributions, because there's a lot of tax benefits in using a tax advantaged account, whether that's a traditional tax advantage, which lowers your taxable income, and then you'll pay tax on many years down the road when you retire, or if you're using a Roth version, which means that you're paying the tax right now, but that you won't pay any tax on the gains when you pull them out. These are both really big tax benefits and something you should definitely consider when you're planning for retirement. I personally prioritize these tax advantaged accounts over an individual brokerage account because it's definitely going to save you money in the long run. The other consideration is, with an employer retirement account, oftentimes the employer will give you what's called a match. Generally speaking, a match is when an employer will put in either a specified amount or a percentage of the amount that you contribute to that retirement account. And essentially you need to look at this as a free raise. As an example, if say you have a company that will give you a 50% match on whatever you put in up to a 6% limit that you contribute. So what this would mean is, as an example, is if I contribute 6%, then my employer will give me 3% in addition. That 3% is 3% more than I would get anyway, that I'm just being paid by the company. So it's effectively a raise. Take the money It's free. Definitely prioritize that over an individual brokerage account. So now if you're a person that's new to investing, I'm sure you're completely confused because I've thrown all these things at you and you're like, well, Drew, what do I buy? Keep in mind, I'm not a financial advisor, but here's some rules that I like to follow. The first rule is invest in what you know. If you don't understand how a company makes money currently or plans to make money in the future, or understand the value proposition of what they're offering, then you probably shouldn't be investing in it. However, if you have knowledge in a specific industry or product and you believe in that industry or product, then this is probably a really good place for you to start investing because you have a leg up on the average investor. Another thing to keep in mind is that individual stocks are very risky. Just because a company is big or is very successful right now doesn't erase the fact that it's only one company. And the reality is that it could go up or down at any point in time due to unforeseen circumstances. So for this reason, I choose not to invest in an individual stock as a large portion of my portfolio. And for most people, I think that it doesn't really make much sense for you to invest in an individual stock unless you've already invested in a lot of other stocks and it's just a very small portion of your portfolio, because I think you're carrying a lot more risk than is necessary. Another thing is, if you're a new investor, don't use leverage. So basically what leverage is it's like credit. Say I'm putting an investment on a stock that is $100 in value, and say I only have $100, so I can only buy one share of that stock. That's not going to give me as juicy of a return, because even if it's 8%, then that means I only get $8. That's boring. Why would I want to do that? Especially when I could go and have a leveraged account where I could say have a 3x leverage, meaning that I'm borrowing to have 3 times the buying power. So then instead of just buying one $100 stock, even though I only have $100, I'm leveraging 200 more in order to get 3 of those stocks, which then means that if it goes up, then I'm going to get 3x times that 8%, which 24% sounds absolutely amazing. Now, the downside of that, though, is that if that stock goes down 8%, then I'm going to lose 24%. As an example, say that stock tanks and drops 33%, I will have then lost my entire investment. Yeah, it's not good. Don't use leverage investments as a general rule unless you really know what you're doing and you're doing it for short term. And so now we come to, as a general rule for a young or new investor, I think the best way to get started is in index funds and ETF. So as I said earlier, an index fund has very low risk and generally follows a market as a whole. They also will have very small management fees, which means that the fund manager that is managing the account, i.e. picking the stocks within it, is not going to charge much of a fee because it's a set and forget investment. This is really important because if you're investing for the long term, small fees can eat up a lot of your profits. This is where the comparison between index funds and ETFs comes in, because ETFs are actively managed and generally follow a specific subset of the market. As an example, you have ETFs for green stocks, meaning the cannabis industry, for commodities like gold and silver, energy, cloud computing, robotics, all these different types of ETFs, which can be very good for a short time period and could even be for a long time period. But generally speaking, index fund like the S&P 500 index is going to end up beating an ETF over a long-term time horizon. That being said, I do think ETFs are a great way to get started into stock trading if you're someone that wants to have exposure into, say, Apple or Amazon or Tesla, but don't want all the volatility that comes with those companies. ETFs are a great way to get started. So based on all of that, what I suggest is that if you're someone that's just getting started, when you log in to Webull or to Robinhood, go and look for things like VTI or VOO, which is look for things like VTI or VOO, which are both S&P index funds. They follow the market, have very low fees, and aren't going to have much volatility, but they're going to go up long-term over time, and they're very safe bets. Another really good one is SPGI. That one's a global focused index of the S&P 500. So that's looking at companies that have more of a percentage of their profits coming from the global market as opposed to just the American market. This might be something just as a hedge, because sometimes the market globally is doing a little bit better than the market in the United States, and then that way you at least have a little bit more diversification. If you want something that's more dividend focused and also costs a little bit less to get into, but still has the low risk advantage of an index fund, would be VYM and SPHD. Both of these would be great options for people that want to get started into dividend investing, but still want to have very low risk in their portfolio. Overall, no matter what you decide to do, don't be scared, and remember that usually the world doesn't end. Make sure to wash your hands, be healthy, and start investing. Thank you guys for watching. Don't forget to like the video, to subscribe to the channel for more weekly personal finance videos, and to share this with anyone that you think might be interested. And in the comments below, let me know what you guys are buying, what you guys are watching this week, and if you end up signing up for one of those stock brokerage accounts, let me know which free stocks you get. And with that, I will see you guys next time.